Congratulations for sticking with us through the whole stablecoin payment series. You now know how to choose the right stablecoin, win over regulators, lock down your cloud and key infrastructure, and connect to legacy rails. In this fifth and final video, we'll put it all together with a clear 4-phase launch roadmap, a sandbox pilot, consumer MVP, a cross-border and B2B scale-up and multi-bank network. If you're new to the series, don't worry, this episode stands on its own. You will still learn how to take a stablecoin rail from whiteboard to region-wide adoption. And when you're ready for a deeper dive, make sure to watch all of the videos in our stablecoin payments guide. Sounds good? Great. Let's get into the video.
I suggest we launch the system in 4 steps. Phase 1, the Sandbox pilot. We file for ADGM Regulab or the DIFC Innovation Testing License. Those frameworks cap us at 500 users, 10,000 dirham tickets, so any bug or compliance misses will stay small. We limit the corridor to UAE and Bahrain because there are already anchors on both sides. The goal is simple. Every transfer must settle in under 10 seconds. Cost under a cent and trigger 0 sanctions hits. If we can't clear that bar with friends and family, we fix the tag before a single retail customer sees it. Let's say the pilot is successful. To move into phase 2, invite the regulator to watch our live logs. Once they sign off, we can build a consumer MVP. We upgrade to a full category 3D license, open the wallet tab to entire UAE retail base and bolt the ANI on-ramp, off-ramp to the app. We'll focus on domestic transactions first to avoid dealing with currency exchanges and sanctions lists. We are aiming for 5,000 active wallets and an NPS north of 65. If the customers hate it, we stop there. If consumers like it, we step into phase 3 with cross-border and B2B payments. We add high-volume remittance lanes like UAE Saudi Arabia, UAE Pakistan, and UAE India, because fees there are still 6% on average. Cutting that to under 1% proves the business case. We also open business wallets with PAF payments exchanges so importers can pay invoices in euros, riyals, or dinars, straight from USDC. That's the moment the treasury sees real float in the corridors and liquidity pools start to deepen. In our last phase, we will invite other banks to our network model. By now, we have the metrics, the regulator's blessing, and enough volume to tempt peers. We sign bilateral MUs, set up shared Firebox workspaces so treasuries can settle intraday in USDC and keep the RTGS bridge for anything systematically important. If the central banks digital dirham pilot matures, we plug that in room, moving from commercial bank money to tokenized central bank money at final settlement. And that's it. Now, hearing those neat milestones, 500 users, then 5,000, 10-second settlements, makes this sound almost too tidy. Real life will throw curveballs at us, I can guarantee that. Are we painting an idealized picture? Absolutely. Every number we've used is an example so we can talk the same language. The moment we go live, bottlenecks will surface we haven't dreamed of. An anchor's bank account could hit a liquidity limit, or the DIFC could change a reporting format mid-pilot. Stellar liquidity could thin out on a week. Those frictions are inevitable, but the upside is enormous and specific to this region. Gulf cross-border retail payments still average close to 6% fees and shut down overnight. Remittances to South Asia alone top 180 billion US dollars a year. If we own the first rail that settles those flows in seconds for pennies, we are winning primary relationships with customers. That's it. If you enjoyed this video and need help building such a system, please don't hesitate to reach out. We have prepared a slide deck, a checklist, and key sources we quoted, all attached in the description. Use them, challenge them, improve them. Also, watch our other content on the topic of stablecoins, and as always, remember to stay on the block to stay ahead.